And that means gold and silver are probably good protection from currency crises for a long way to go from here. This isn't a time to be cashing out. This is still maybe a time to be adding cautiously to precious metals positions because, we could see some really outrageous numbers, certainly in gold and definitely in silver in the not too distant future. And you want to be there for that. You don't want to miss the big parabolic move at the end. Gold miners are suddenly popping up for the first time ever, so the momentum money is starting to chase precious metals miners, which gives them that last big parabolic leg out there at some point. So now is still, despite those stocks having done really well for a while, it's still a good time to be buying them wisely. Don't just jump with both feet into whatever has gold or silver in its name, but buy quality. And you still have a good chance of making lots of money in the next few years in those things.
As debt levels spiral out of control and trust in government-issued money continues to decline, pressure inside the global financial system is constantly increasing. It's become harder to ignore the math underlying modern economies, from growing budget deficits to rising interest rates. Real assets are once again taking center stage in this scenario, with gold and silver acting as insurance against a system that has been overextended rather than as speculative trades. Longtime credit cycle and systemic risk analyst John Rubino contends that the current slump is actually the beginning of a full-blown sovereign debt crisis. In response, governments are silently sacrificing the value of paper money by borrowing more, printing more money, and engaging in greater financial engineering. Rubino demonstrates how this pattern has often occurred throughout history, from declining empires to contemporary affluent nations, and why the current cycle is occurring on a far larger and riskier scale. If you want more content on precious metals investing, be sure to like, subscribe, and click the bell.
What's that sniffing? Let's work that out for me. What's that telling us right now in the global economy, I would argue?
Well, the gold and silver story was always, for the past 20 to 30 years, been that the big countries of the world, now that they're doing fiat currency experiments where their currencies aren't backed by anything, right, and they have unlimited credit cards effectively to borrow and spend as much money as they want to. They're abusing that power and taking on way too much debt, creating way too much currency to finance that debt, and that would eventually lead to inflation, which is to say a disorderly decline in the value of the big fiat currencies. And we're finally there. This morning, as we're speaking right now, gold and silver are both way up, and silver is outpacing gold, which is normally how the late stages of precious metals bull markets go. You begin with gold because that's the big name in the sector. When you're nervous about what currencies are going to do, you buy that gold, the gold goes up. And then you realize that for the 1 ounce of gold, you can get a whole pile of silver, and your aesthetic sense takes over. You want that big pile of really gorgeous coins. And so people start buying silver, and that, being a very thinly traded market, starts to go straight up. That's where we are now. So the question is, is this a gold and silver run like the previous two in, 2000, in 1999 and in 2007, 2008. Anyhow, the past two long precious metals runs we've had gold and silver topping out. Well, gold not quite at this level in real terms, and silver at $50 an ounce or so. So the question is now, is this move like those moves, or is this one a very different animal because this is the end of the fiat currency experiment? And I would argue that, the latter probably, that we're towards the end of the experiment now because governments are just awash in debt. The interest on their debt is soaring. The U.S. pays more in interest now on its debt than it pays for defense. Mm-hmm. You can't manage something like that for very long. So we're in the death spiral part of the process. And that means gold and silver are probably good protection from currency crises for a long way to go from here. This isn't a time to be cashing out. This is still maybe a time to be adding cautiously to precious metals positions because, we could see some really outrageous numbers, certainly in gold and definitely in silver in the not too distant future. And you want to be there for that. You don't want to miss the big parabolic move at the end. Precious metals, which is really the basis of a wisely structured financial life right now. You get physical first. You get some gold and silver coins, you store them in a safe place. And when you've got enough of them, then you start looking at ways to branch out into equities, to increase your exposure to precious metals. And starting with that, there are physical ETFs, which are basically stocks of companies that just get a bunch of gold and silver or whatever, put it in a vault, and then you invest in them, and they hold that gold and silver in a safe place for you. That's not 100% safe. There's still counterparty risk because you have to trust them to have in their vaults what they say they have. But they're relatively safe when they're well run. From there, you go to the big ETFs. Those are investment companies that buy the stocks of the gold and silver miners, and they take care of the portfolio construction for you. They just go out and buy the representative stocks, and so you get some of those, and then you've got exposure to mining equities from there. And then as you dig a little deeper into it, you start making your own decisions about which mining stocks you want to own, and from there you start with the big guys that are easy to analyze because they're just, Newmont is the biggest gold miner in the world, and all the analysts are looking at Newmont. And so you got to figure it's reasonably well covered. It's reasonably, it's priced close to its value and everything. And as you gain an understanding of things like mining stocks, you work your way down. There are junior miners that produce gold and silver, but not enough to be considered senior miners. But they're also, they're not as widely followed. They're a lot more volatile. So if you choose wisely, they'll go way up for you compared to the other ones. And then from there, you get down into the explorers and the companies that don't actually have mines yet, but they're digging out there. They're looking for new deposits. And that's where you find your 10 baggers in the mining space. The little guys who nobody really knows much about, but are still putting out pretty good drill results. So you analyze those drill results, look at other things like how experienced management is, whether they've done this before, what jurisdiction the potential mine is it in a place where you consider it to be, well respected and treated by the local government, and you make a choice. And I mean, over the past 10 or 15 years, there have been a bunch of companies that fit those criteria in the explorer space, and they've gone up 5, 10, 20 times from when they were little and unknown, and so you want a few of those because that's life-changing money. If something goes up 20 times, you only need a couple of those to have made a successful life as an investor. And those are the things, and you got to be careful with those because they're addictive. Once you had something go up 20 times, you want that feeling again. Yeah. And that you did it once, you're a little cocky. So you're addicted to the feeling and you're kind of cocky about your abilities. And then you can go out and buy 10 more of those things and all of them will go bankrupt or something like that. So you need to be very careful to not think you're a genius when you win a couple of times in that space. But anyhow, you do that, gradually work your way into the mining space. And once you have enough understanding, then it becomes a really fun game to play because especially in times like this, where the last couple of years, the gold and silver miners have been the best performing financial sector in the world, better than cryptos, better than AI stocks. You wanted gold and silver miners. And so once something like that happens, it gives them legitimacy. And so now the next run is starting with them because Wall Street is catching on. They've got these momentum charts out there where they're on their screens. Gold miners are suddenly popping up for the first time ever, so the momentum money is starting to chase precious metals miners, which gives them that last big parabolic leg out there at some point. So now is still, despite those stocks having done really well for a while, it's still a good time to be buying them wisely. Don't just jump with both feet into whatever has gold or silver in its name, but buy quality. And you still have a good chance of making lots of money in the next few years in those things.
As governments push their financial systems beyond what they can reasonably maintain, a global currency collapse is starting to take shape. For many years, nations have maintained their economies by perpetual money creation, rising deficits, and unending borrowing. Ordinary people are also under a lot of pressure. Student debt has become more difficult to repay, credit card rates are close to 25%, and more borrowers are falling behind on their auto payments. Households start to spend less as they suffer. Businesses businesses make less money when consumers spend less, which reduces profitability and increases the likelihood of a significant market slump. Such a drop might be significant enough to compel governments and central banks to take emergency action once more. However, those remedies typically result in increased debt and money printing, which exacerbates the initial issue. Money shifts into actual, tangible assets like farms, energy resources, and particularly gold and silver as confidence in government bonds and national currencies continues to decline. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
Well, governments have screwed up their currencies since we've had currencies.
Right.
A government will start borrowing too much money, and then debasing their currency in some way, and then people lose faith in the currency. Its value collapses, and then each and every time we've gone back to gold and silver because that's humanity's original money, and it can't be debased because you have to dig precious metals out of the ground, and that's hard and getting harder to do all the time. So that limits the supply of those things. And because they're rare, they tend to hold their value going forward. And that's where people pile into when they suspect that their government is screwing up their currency. Now, what's happening now that's different is that in the past, currency crises used to be one country devaluing their currency dramatically. In the context of the sound money world, everybody else was on the gold standard. You screw up your currency, you have a crash, and then you go back to gold and silver. Well, now it's the whole world, basically, or at least all the major countries. They have fiat currencies. They're inflating them away at varying rates. And so this is going to be different in that sense, in the sense that it's a global currency crisis because, if the dollar starts tanking, that pulls down the euro, that pulls down the Swiss franc, the British pound is going to crash no matter what. And the Chinese yuan is being inflated away really aggressively as well for their own reasons. So all of these things are going to happen kind of simultaneously once they get going. And you can make the case that they're already happening.
Right.
That we had this burst of inflation during our response to the COVID pandemic. So the cost of living is already much higher than it was a decade ago. And so they're hoping for like 3% inflation in the US going forward and thinking that fixes things. But it doesn't actually because most people's cost of living is already way up. So having it grow by only 3% a year is still a crisis for the average person. And we've got a recession coming, which we can talk about the details of that in a minute. But let's say a recession happens. Governments usually respond to recessions with dramatic increases in spending, which means if we're running $2 trillion a year deficits now, we'll run $3 or $4 trillion deficits in the face of the next recession. And that'll just spike interest costs, which they have to be borrowed. So that will spike next year's deficit, et cetera, as we enter a death spiral where the currencies just start to fall off a table. And I would say that we're basically there. We're at the beginning stage of that, and there's no way out of it. So, yeah. Fiat currencies are currencies that allow governments to do this, basically. In other words, they're not backed by anything, so governments are free to borrow and spend as much as they want. We started that experiment in 1971, and it's kind of come to fruition now. So the question is, what happens after? Because it's kind of guaranteed that we're having that big currency crisis. So, do we do a currency reset where we go back to a gold standard? And do we bring Bitcoin into the mix? Or do we just, run it out and have kind of a Weimar Germany hyperinflation that nobody can predict the outcome of, and hopefully we'll do the smart thing, which is a currency reset sooner rather than later. But when have the guys in charge of most of the big countries done the smart thing in our lifetimes? And the answer is almost never. So it's completely possible that we have just a horrendous currency/financial crisis in the not too distant future, and we basically just have to live through that. And right now, we should be trying to prepare ourselves for it.
In the end, John Rubino is stating that governments have a lengthy history of devaluing their own currency. Governments repeatedly borrow excessive amounts of money, spend more than they can afford, and then attempt to address their issues by printing more money. This appears to be effective at first, but it eventually devalues the currency. The currency falls when people begin to recognize that their money is becoming less valuable. When this occurs, people have always gone back to gold and silver throughout history. These metals are difficult and costly to get from the earth. They cannot be printed, and governments have no control over them. According to Rubino, the current scenario differs from previous ones, in that currency crises often occurred in a single nation at a time. While the rest of the world continued to use a more stable system, frequently backed by gold, one country would ruin its currency. However, almost all of the world's major nations now use fiat money, which has no actual backing. China, the United States, Europe, and the United Kingdom are all simultaneously inflating their currencies. This implies that the next crisis will be worldwide rather than local. Other major currencies will decline along with the US dollar if it begins to decline sharply. Rather than a single currency failing, they might all begin to fall at once. Rubino notes that during the COVID response, when governments generated enormous sums of money, we already witnessed the first indications of this. The expense of living increased dramatically as a result. Everything grew more costly, and the damage is already done, even if inflation eventually drops to about 3%. Thanks for watching. If you like this video, give it a thumbs up, subscribe, and turn on post notifications so you never miss an update.